webinar. My name is Dominic Borquin and I'll be your host today. Just a bit of admin before we start. We can answer questions, so if you'd like to type them in the question box as we go along, I may answer them then and there, or I may answer them at the end. But if you do have any questions, please feel free to ask them, and if I can't answer them immediately, I'll get back to you at a later date. So without further ado, what are we going to be talking about today? Well, the first thing we're going to be covering is child benefit changes and how they affect you. There's been an awful lot of publicity about this, and I imagine a lot of you know an awful lot about it. However, I'm going to talk briefly about the changes, but I'm also going to talk about some of the personal tax admin that necessarily comes with those changes, which is, as with everything to do with tax, not necessarily that straightforward. The second subject we're going to tackle is inheritance tax, and the fact that the debts of the deceased may now not reduce the estate value. There are some changes there that mean that what would be normal debts of the estate in the past and would have reduced the value of the estate that's taxed to inheritance tax, those debts may now not be deductible for inheritance tax purposes. So something to warn you and your clients about, I think, going forward. And the last point is late claims. You may be in a situation where, for whatever reason, you have overpaid tax and you'd like to reclaim it, but for some reason you've missed the time limit. There are certain circumstances in which you can make a late claim for that overpaid tax, and I'm going to focus today on one aspect where the Revenue have issued new guidance, and it's just a slight twist on what was there before, but what it does mean is it means that if you are doing something they consider to be not perhaps how you should behave, then they may well not allow you the late claim. So let's move on to the child benefit changes. They came in from the 7th of January this year, and the major changes are that if you or your partner have income in excess of 50,000, then your entitlement to child benefit is reduced until at an income level of 60,000 there is no entitlement to child benefit at all. So effectively it's a sliding scale between 50 and 60,000 of reducing child benefit until you get to £60,000 of income, and at that level there's no entitlement to child benefit at all. So if you think you or your partner may be affected, then you've got to go through a decision tree type process really to decide if you are going to be affected. The first thing is, do you or your partner have income in excess of £50,000 a year? If you do not, then there are no changes and you'll be entitled to child benefit as before. If one or other of you or both of you has income in excess of £50,000 a year, then you've got to decide if you or your partner receive child benefit or someone else receives child benefit for a child living with you. If after that test you think you qualify on those grounds, then you will be affected by these child benefit changes. So if you are losing your entitlement to child benefit, or indeed have already lost it, then you have a choice. You can either continue to receive the child benefit, or you can elect not to receive child benefit. So the question is, well, why would you elect not to receive the child benefit? Well, if you are affected by these changes and your entitlement to child benefit has been reduced, or in fact removed entirely, then the partner who earns in excess of 50,000, or if both of you earn in excess of 50,000, the one who earns the most, must register for self-assessment. That is, submit a tax return, and the child benefit will be collected back via your tax return. So the first point to note, therefore, is that if you do continue to collect child benefit that you are not in fact entitled to, you will have to submit a tax return every single year. And of course it may well be the case that your partner has received the child benefit and you haven't, and yet it will be collected back via your tax return. And that's the other point to note, is that the child benefit will effectively be repaid. So when you submit your tax return saying, I am affected by the child benefit changes, the tax will be collected on submission of your tax return. So if you want to continue receiving the child benefit after the 7th of January 2013, even if you're not entitled to it, so it's collected back via your tax return, then you should have registered for self-assessment by the 6th of October. That's 9 days ago. Because you will have to submit a 12/13 tax return by the 31st of January 2014. So the message here is that if you are collecting child benefit that you are not in fact entitled to, you must submit a tax return and you will have to repay the child benefit. It's easy enough to register to submit a tax return. You just use form SA1, which is available at hmrc.gov.uk. However, If you do not submit a self-assessment return, and you should have done because you're claiming child benefit you're not entitled to, then there may well be penalties falling due. So you may get to a position where in fact you not only have to repay your child benefit as expected, but also if you are late in submission of your self-assessment return or you don't actually submit one at all, there will be penalties falling due. So in order to circumvent all that, let's say, awkwardness, and it seems to be a bit of a nuisance to have to submit a tax return for child benefit purposes if you don't have to submit one for any other purposes, and also having to repay child benefit, if you're anything like me, you've probably had it and spent it, you may want to elect to stop receiving the child benefit to start with. If you do wish to elect to stop receiving the child benefit and avoid all the admin we've just discussed, then there is a form available, and it's at www.hmrc.gov.uk stop CHB payments. Relatively straightforward form, and that means that you will never then receive child benefit, and your requirement to submit a tax return to allow them to collect child benefit you've received that you're not entitled to will fall away. One last point is that your circumstances may change. So you may not earn over £50,000, and at the end of the year you get a bonus that takes you into that £50,000 to £60,000 bracket. If you fall within that, clearly you will have taken child benefit that you may not be entitled to, and therefore you may again fall within this regime of submitting a tax return, paying back the child benefit, etc. So it's critical to make sure you monitor your income levels if you are anywhere near the 50,000 threshold, to make sure that you don't fall within it. And I would advise you to do that on at least an annual basis. So that's all I've got to say on child benefit. If we move forward now onto inheritance tax and debts of the deceased. As you'd expect, if you die owing people money, generally speaking, the debts and the money that you owe is deducted from the value of your estate that is charged to inheritance tax. So the charge to inheritance tax arises after we've taken the value of the debts off the value of what you owned when you died. This includes credit cards, overdrafts, personal loans and mortgages. As you'd expect, nothing sinister there. However, this is where it does get a little bit tricky. The Revenue have issued new guidance with absolutely no consultation, which frankly is irritating, because generally speaking these things you come across by default. You're looking for something else and there's a new piece of legislation that suddenly has appeared where you don't expect it. This is not a very well publicised change, and it's something that effectively is applicable from the 6th of April 2013. What does it do? Well, what it does is it prevents executors deducting certain liabilities of an estate from the taxable value. So some of those debts we've talked about, if they fall within certain circumstances and you die owing the money, will not be deducted from the value of your estate. The value of your estate will therefore be more, and therefore any inheritance tax will also be increased. So what are we talking about here? Well, there's two categories of liabilities affected. The first one is debts that have been incurred by the deceased in order to purchase IHT exempt assets. So if you are a businessman and you incur a debt to buy shares in an unquoted trading company, those shares are exempt from inheritance tax. But of course you might have borrowed money to buy those shares, so that's the sort of debt we're talking about here. The second area is debts that the executors do not pay off on death. So you may have a situation where you have a life insurance policy that covers off your mortgage. Well, that life insurance policy is generally held in trust, is not part of your estate at death, and yet the mortgage is paid off by it. So the mortgage on your house will not form a debt of the estate, and therefore the gross value of the house will be included for inheritance tax purposes. Now, HMRC have rather glibly stated that these new guidelines have been issued to counteract certain avoidance schemes. I'm not so sure, to be honest with you, because I think they will absolutely catch two completely innocent arrangements. At least two is what I should say. The first one of these is, as I briefly mentioned, homeowners. Most homeowners will have a life insurance policy written in trust to cover the mortgage in the event of their death. So if you die with a mortgage on your house, that life insurance policy is not part of your estate, and yet it pays off the value of the mortgage. So for suddenly the mortgage debt on the house is ignored for inheritance tax purposes, the value of the estate is increased, hence the amount of inheritance tax that may fall due is increased as well. Now, again, rather dismissively, HMRC have said, well, executors of estates could just refinance that mortgage and then pass the house with the new mortgage to the beneficiaries. As we know, the banks being what they are at the moment, refinancing any sort of debt is not necessarily that easy, and therefore I don't think that's necessarily a great response from HMRC. But those are the rules, so I think we need to be aware of that when we're advising clients about the value of their estates for inheritance tax purposes. The second example is businessmen and farmers particularly. Very often businessmen and farmers will borrow money to expand their business, and the debt will be secured on the value of personal property. So they may borrow against the value of their house in order to invest in new shares in a company, or to perhaps to invest in land for their farm. Now, if you invest in unquoted shares, so shares not listed on the stock exchange in a trading company, or you invest in certain types of agricultural land, you will be completely exempt from inheritance tax. So if you've borrowed and secured those debts against personal property to invest in those exempt assets, then the debt you've incurred, if you were to die, will not be deductible from the value of your estate. So we need to be very careful about what we secure personal debts against when we're investing in assets that are not subject to IHT. So principally that will be certain types of agricultural land and shares in unquoted trading companies. HMRC have turned around and said, well, okay, we accept we didn't consult on this measure, so debts incurred on or before the 5th of April 2013 will be outside of these provisions. Fine, okay. But the point is because they didn't consult, these changes have not been widely signalled anywhere. So I think we need to be aware of such a financing arrangements going forward, and just make our clients aware that actually there might be a problem, and they should perhaps look for a different structure to their financing arrangements to make sure there is some inheritance tax relief for debt they incur to invest in inheritance tax exempt assets. So moving on to late claims. By concession, aren't we lucky, HMRC agreed that where an overpayment of tax occurred and the overpayment is due to an error by them or some other government department, and a claim to repay that tax is made by a taxpayer outside the time limit, then the revenue will repay the tax. So you may have a situation where the revenue have actually advised the client that they've got a longer time to pay, a longer time to claim something than they actually have, or they've advised the taxpayer that a claim is not possible, and it is. And in those circumstances, the revenue will allow the tax to be repaid to the taxpayer. There is another fairly narrow area where they will allow a late claim as well, and that is where the reasons for lateness are beyond the taxpayer's control. When I say it's narrow because you have to be so ill that it prevents either the taxpayer from making the claim, or it prevents them from going to their advisors and getting their advisors to make the claim, so seeking assistance from an advisor to make that claim. So I'm not sure there's anything particularly controversial in there, but let's just briefly look at the reasons that might be outside of the taxpayers, that are not outside of taxpayers' control according to the revenue. The first one is oversight or negligence of the taxpayer, their agent or advisor. Well, fair enough. If you overlook something, that's your own fault. If you make a mistake as to the meaning of legislation, that also effectively means that you are not going to be able to reclaim that tax if you're outside the time limit. The other thing is if your advisor is ill. Your advisor may be critically ill or be taken into hospital at the last moment, and if they don't make the claim for you within the requisite time limit, that is not a good enough excuse, and you will not be able to reclaim that tax. However, there's now a further overarching provision, and that is that if you try and make a late claim and you have that claim or election forms part of a scheme or arrangement, the main purpose or one of the main purposes of which is the avoidance of tax, then the revenue may take that into account when deciding whether to pay your late claim. So imagine the scene. You have implemented a fairly bog standard, dare I say, tax avoidance type scheme, and your advisor falls ill, so therefore some of the claims that should have been made are not. You then submit a claim late, and you were too ill to make the claim, and you were so ill you couldn't get your advisor to make the claim, you submit the claim late, and the revenue will say, oh, now, what was that to do with? Oh, it was to do with that particular tax avoidance arrangement, was it? Well, in that case, I'm not going to allow you to to repay the overpaid tax. So I think it's an interesting change of attitude from the revenue, because they're not limiting this qualification to particular schemes or arrangements. They're not defining which schemes or arrangements it applies to. They're just saying, if you miss a late claim deadline, and it would normally be the situation where you can reclaim that overpaid tax, if you've implemented a tax avoidance scheme, you're absolutely not going to be allowed to reclaim that overpaid tax. That is an interesting change of heart, and it's an interesting reflection of how the revenue operate these days, and I thought you should be aware of it. That's all I have for today. Thank you very much for listening. We haven't had any questions, but if you'd like to ask them, I'll be around for the next couple of minutes. The next Monaghan's Bite-Sized Tax Highlights webinar is on the 13th of November. As always, these slides and a recording of this presentation will be available on our website, and I hope to see you, or see you at least, for you to register and us to engage on the 13th of November at the next webinar. Thank you very much for your